Hello. Today we will talk about some valuation of stocks I think it's worth to talk about. We will begin with Salesforce, for example. My app says this stock is currently overvalued by at least 50%. However, on some platforms, we can see that the consensus of the analysts are saying that the stock is currently undervalued by 24%. Okay, but first, we don't know based on which hypothesis, which growth, margins, time frames, or when could we expect this upside to happen. I will then explain my view. First, we need to understand what operating cash flow is. Operating cash flow represents the difference between all the cash inflows a company gets, revenues, and the cash outflows, wages, raw materials, and so on. And then, what are stock-based compensation? Stock-based compensation are a kind of a bonus, a part of the wage, which are given to the employees. But it's not cash. Then it's not subtracted from the operating cash flow. But in my opinion, if we want to study the profitability of a company, we need to remove stock-based compensation from the operating cash flow. Imagine a first company, company 1, which generates 100 in revenues and pays a wage of 75. Saying it's the only cost we have, if we want to compute the operating cash flow, we add the cash inflows, 100, and we remove the cash outflows, 75, which gives us 25 and then a 25% in operating cash flow margin. Now, imagine a second company, company 2, which generates 100 in revenues as well and pays a wage of 50 and 25 in stock-based compensation. As said earlier, to compute the operating cash flow, we subtract the cash outflows from the cash inflows. Then we get 50 and then an operating cash flow margin of 50%. Isn't it weird? How are the stocks given to the employees? We basically have two possibilities. First, the company will buy back shares on the market. It means the company will buy back for 25 in exchange for its own shares. But it's a cash outflows, right? However, this operation will not appear in the operating cash flows computation, but in the financing cash flow, where we have non-repeatable operations such as a building. But it's not fair. Stock-based compensation are offered each year to the employees since it's a part of the wage. Then it's repeatable. The second possibility is they will create for a value of 25 of shares and give them to their employees. Imagine if the current market cap of the company is 1000 and we had 1000 shares. After this operation, there will be 1025 stocks, but has the intrinsic value of the company changed? Did we create value with this operation? Absolutely not. Since the intrinsic value of the company has not changed, it means that all shareholders have lost a part of the value. Look how big the difference is coming back at our table. Look, we have currently, taking into account stock-based compensation, an operating cash flow margin of 16. If we move to zero stock-based compensation, we have an operating cash flow margin of 26 on the past 5 years, instead of 16 if we take stock-based compensation into account. And of course, it has an impact on the free cash flow as well. If we take stock-based compensation into account, we arrive at a value of $180 per share. Without stock-based compensation, since our operating cash flow is higher, we arrive at the value of 300. Are you still sure you should not take stock-based compensation into account? I am not so sure. It's the reason why I prefer being conservative. If tomorrow's morning the incentive for stock-based compensation is not as good as they currently are, the wage of these employees will increase and the operating margin will be reduced. One more thing is what the meaning of all this. When you compute a DCF model like this, you are trying to answer to the following question. What would be the intrinsic value of the stock today? Considering these hypotheses, a growth of 17, an operating cash flow margin of 16, and a capex margin of 2.4 during the next 5 years. And if the company realizes these results, the intrinsic value of one share today is worth 180. Then, what's the next step? The next step is determining if they can deliver this outcome. And for that, we can look at their latest quarters. In fact, they already delivered 3 quarters since these 2025 results. Taking into account SBD, where it is, taking into account SBD, we arrive then at 9.5 minus 2.4 divided by the revenues, $30.3, and we arrive at the margin, an operating cash flow margin of 23, which is then higher than our expectation. However, if we look at the growth, we have 30.3 from 27.9. I already made the computation. We arrive at a growth of 8.6, which is then a lot lower than our expectation. Then even with the new number, if we take 8.6 and 24, we arrive at a current value of the stock of 188. You may make all this competition yourself, or use the app I built where I already compute all these margins and DCF values to help me find the best opportunities available right now, and where I use AI to answer a bunch of predefined questions on the most profitable stocks. Tell me your opinion in the comment below if you think we should consider stock-based compensation differently. And if you found this content useful, like the video and subscribe.